Thanks, Steve. Yeah, thanks for that intro. People have been farming, sort of, in a way. We farm now for about 4,000 years, probably, and as long as people have been farming, it's fascinated us, and people have been writing and talking about it. Like about 50 years ago, the US President Dwight Eisenhower said, "Farming is mighty easy when you use a pen instead of a plough." He said, "It's mighty easy when you're 1,000 miles away from the paddock." If we go back even further, Varro, about 100 BC, he said, "The father of agriculture gave us a hard calling. He did not will that the way of agriculture be easy." And he went on to say, and if you're farming and you find you're not making a profit, or he said, if you find it is not healthful, and in spite of this, if you keep farming, he said, you should be taken in charge by your kinsmen and family. Now, there's probably not one of us here, and at some point, geez, I must be mad to be doing this, but generally, I guess we love it. Like there's an old farmer where I grew up in the 60s, he still went round the flock on an old three-quarter draft horse with a chaff bag on as a saddle. And he used to poke around the street, and he was always, the old horse, he was nearly 90, and the horse was nearly as old, and the old horse was called Dole, and he was always saying, "It's not old age that's killing you and me, Dole, but hard work and worry, worry, worry." And that's what I want to talk about today, really. It's not the worry, 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 but it's the fluctuations of things that could cause you to worry unless you're really on top of how your business operates. So what we're talking about is the challenges of volatile seasons, markets and finance in beef production. But what I really want to first sort of talk to you, I just want to show you how someone who's trained in agriculture and farm economics thinks about farm or a beef system, right? We've done some analysis. There's a paper there in the book. There's some notes. There's some PowerPoint notes. You can put that in the ute, and one day when you get stuck, you've got to kill some time, you can go back through it because there's a lot in it. Okay, and I'll just give you an introduction today. But the situation is, we've imagined it's in the Western District, Victoria. We've bought a border about to buy a 1,500 hectare property, and it'll carry 14 DSE, it'll carry 20,000 DSEs all up on average. He's thinking about how to run it, he's going to run beef on it, and so we've done some numbers on it, right? But the emphasis has been on the volatility. What sort of risk are we facing? And then when I say risk, seasons, prices, and service, your debt, basically, right? Three main risks: seasons, prices, service, and the debt. And that's the sort of background to it. But I just want to sort of talk about how farm economists see it. Farm economics, we say we use the whole farm approach, right? Now, you've got to know sort of a lot about a lot to do it, because I think of the farm as comprising first the human bit. You start with the people that's a given. You've got to figure out why, to understand why a farm's been run how it is. You've got to know what people are trying to achieve who are running it, right? So, and then you've got to figure out what resources you've got to work with and all that. So first of all, there's a human bit, then there's a technical bit, which is what the soils, plants, animals, pastures, all of that. Technical, then there's economics and finance, and they're different. Economics is about efficiency, return on capital. Finance is about servicing your debt. So we've got human, technical, economic, finance. Risk is another bit. And then we've got beyond the farm. Okay? Now beyond the farm stuff we can't do much about. And people might say, well, if the biggest influences are beyond the farm, well, why worry? What can I do about it? The economist says, well, because the things you don't have much control of things beyond the farm, it makes it even more important that you do really well what you can control within the farm. Okay? And then the risk angle then is sort of manage those risks you can control as well as you can. Okay? And minimise your exposure to risks that you can't control, which is pretty difficult in agriculture because a lot of the risks you can't control and you can't minimise exposure to them very much. But the extent you can, that's the way to go. So the sort of philosophy of this farm economics is you've got to look at the whole of the system, like answers to parts of there's problems in the, or answers to parts of the system aren't solutions. Solutions to parts of the system aren't solutions to the whole. Right? Solutions to parts aren't solutions to the whole problem. So every sort of question has got human, technical, economic, financial, risk dimensions to it, and you sort of got to look at all of them. Come up with, that's what economics does. That's what farm economics is. It's called the whole farm approach. And the philosophy is, you're better to be roughly right than precisely wrong. There's no good getting a very precise solution to a part of the problem if that's not the real problem. You have to identify the real problem. You've got to look at the whole of the system, right? So it's a whole farm approach. And look, what I find, like, it's a lot easier. I worked with scientists all my life, and it's a lot easier to know a lot about a little than a lot about a lot. Okay? And yet we need, to do science, you've got to know a lot about a little, right? More and more about less and less. And that's good because that's how we progress knowledge. But then to manage a system, the world doesn't come to us in disciplines. It doesn't come to us in bits. It actually comes to us as a whole package, and you've got to manage all that, or you've got to understand how all that fits together. So that's the approach. You're better to be roughly right than precisely wrong. You've got to come up with approximate answers to the whole problem than a very precise answer to part of the system that's not really the whole problem. But what I find is that my specialist colleagues, my disciplinary specialist colleagues, we all do it. We find problems where we look, right? And we look where we know. So my agronomist mates will always find, look, this farm I'm talking about, the West District, I'll say, look, these pastures are just not up to it. Right? They've been badly managed, blah, 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 it's all bent grass. My vet colleagues, naturally, they just find it's all in the cow's guts, right? It's all animal health problem. Just fix this up and you'll be right. As if fixing one part will make it right. But you've got to fix that bit, but it won't make it right. And the soil science colleagues will find you poorly managed soils and poorly drained to acidic, whatever. My sociology colleagues will find, look, it's simple. The husband and wife just don't like each other. Okay? The economists will find something very precise. Person interested in finance will find you're too highly geared. To do farm economics, you've got to do all that stuff, right? Or at least work with good technical specialists to get it right. Because the key is, I'm arguing, is it's all about getting the question right. The question is the answer in a way. Once you've identified the problem, once you've got the question right, the answers are usually fairly obvious. And usually there's a couple of ways you can go. The key is identifying what the real problem is. Well, you might think, oh, the problem is low income. Well, actually, no. It's to do with productivity. And what sort of productivity? Oh, well, it's past production that you're managing to grow, how much past you're managing to grow and how much you're consuming. So it's all about drilling down to finding out what the real problem is. Once you've identified the question properly, the solutions are often, I think, fairly obvious. Okay? So that's the philosophy, that's the approach. And, oh, good. Yeah, and what we're going to do today now is something here. Very good. Right, very good. So, yeah, that was the brief I was given. How do you think about these problems? And roughly, we've written a paper and it says, we bought a farm, how best to run it, right? We bought a big property, how best to run it? What are the risks that matter? And of those, which of them matter the most? Because they don't all matter equally. So let's try and pin down which of them really are the ones that are this is getting the question right, right? Which risks should we focus on most? Then the obvious question then is what stocking rate? That's the big question in any animal production system. What's the right stocking rate to have? The second question then is, and I get asked this every meeting I go to, I reckon a farmer will come up to me and say, how much debt should I have? And the answer is always the same. The answer is it depends. And so we'll go through some of the it depends in that paper. Once we've decided that running 1,000 breeders, 20 DSE, a breeding unit, right? This is a breeder producing a weaner, then carrying it through to take 14 months, selling it at 380 kilos, 400 kilos, getting $2 for it. That's the system we're running. And then we'll talk a little bit about managing the risks. So, first thing we do is we break down, there's two different types of risks. And there's what we call business risks, and that's basically your prices, your exposure to the price you're going to get for your product, exposure to whether it's going to rain or not. The other type of risk is financial risk, which is how much debt you've got in your business. Now, you have some control over that as a farmer, as a business person, at least in the first instance. When you said, in this case, we're setting this business up, and the question is, should I go in with 70% equity? Should I go in with 80? Should I go in with 90? And we do some sums on that question. Now, if you look there, I've just in the paper, I've got some interest rates there. It's not that interest rates themselves don't matter. It's the total interest bill that matters. So obviously, it's the amount of debt is more significant than the actual interest rate. Even though you said they fluctuated a fair bit. I was just looking at them before. There's the cash rate, which is the base rate, and then you've got an overdraft rate up there with security. And I was just wondering, this is 94, that's 2014. I just hope that the difference between these two haven't widened over time. You sometimes suspect they might have, but you'd hope they haven't. But the interest rate's going down, but it's really your total interest bill, which is dependent on how much debt you've got. I want to just make one important point here before we start talking about the farm. There's a really important principle to understand called the principle of increasing risk. And it might seem bleeding obvious, if you've got more risk, the greater the chance you'll go great. But it actually, there's a bit more to it than that. Back in the 30s, a good Polish economist asked the question, why don't businesses just keep getting bigger and bigger? Why don't they just keep borrowing and borrowing and borrowing and growing and growing and growing? What stops them? Now, this principle of increasing risk is what stops every business, including beef businesses, getting bigger and bigger. It's not usually the technical side of it, it's actually just the financial side that stops. It determines how big your business should be and can be. And I just want to show this principle with some arithmetic. Quickly, we've got a $10 million business, right? Let's say we've got no debt. $10 million business, we make a 10% return on that, that's a profit of $1 million. All with me? 10% of 10 million is $1 million. No debt, no interest, so that $1 million's all yours, right? So your growth in wealth, if you earn your 10% with no debt, is $1 million. Everyone with me? Convinced? It's arithmetic, can't be wrong. Righto, there's no debt. Now we've got 5 million, we've got 50% debt, 50% equity. We've got 5 million your money, 5 million from the NAB. Put it together, we pay 8% to the bank money. We still earn our 10%. We get an operating profit of $1 million. Who gets the first slice of that? The bank. They want 8% of 5 million, which is 400,000. With me? You've got to pay interest on the $500,000 you borrow. Pay the 400,000, you're left with 600,000. Your 5 million has grown by 600,000, hasn't it? And that's 12%. Hello, we're on a magic pudding here. This is the way to go. Can't go wrong. Borrow money and you'll grow faster. Absolutely true, as long as you earn more than the rate of interest you pay. So this is terrific. And that was Koleski's question, why don't businesses just keep borrowing? Because you can grow faster and faster. And if I had 90% debt, I'd grow at 30% if you do the sums. Great idea. Now, the flaw in this, of course, is that you don't always earn your 10%, do you? So let's throw in, make a 10% loss. Now, we've got $10 million, we make a 10% loss. Profit is, or loss is minus 1 million. Our equity is rated by $1 million. We've gone down by 10%, haven't we? No debt, we've just lost 10%. All with me? Second case, we've got 5 million of ours, 5 million to the bank. We make a 10% loss, so we go down $1 million, plus we go down another 400,000, we've got to pay the bank, haven't we? So we've got to pay your interest. No one say, oh, sorry, I made a loss, so you're not getting your interest. Try that one. We'll go down well, won't it? So, you've gone down 1.4 million, 1.4 million on your 5 million is 28%. Suddenly we're heading downhill at a much faster rate than we were going to head uphill. We were going to go uphill, we're going to make progress at 12% when things went well. When things went badly, we went backwards at 28%. Principle of increasing financial risk. Really important principle, as I often say, that's the lecture that Alan Bond and Christopher Skase missed. This is the one that determines how much debt you should have. This is the one. If you use other people's money well, you'll grow faster. If you use it poorly, you'll go backwards even quicker. Then you get into this snowball effect where your equity's eroding. Why did you make a 10% loss? Or your asset values have declined, your land value is less, your stock value is less, etc., etc. Suddenly you get more and more highly geared. Like I see businesses that go out backwards, and I say, how the hell did they get in that position so quickly? It's this snowball effect going backwards fast. So, I want to keep that principle in mind because later, the rest of the talk I want to talk about financial risk. That's what I'm talking about, getting the right amount of debt. That you can be confident you'll service. I'm short of time here, I know, so we'll keep moving quickly. There are the questions, how many breeders, how much debt? The farm economists can come up with advice about this. The decision maker has to weigh it up. We do the sums on this hypothetical farm we bought. There's the gross margin per DSE, an average. And it's always, by the way, it's always been about $20 per DSE since I've been doing this stuff, which is 30 or 40 years. So, gross margin per DSE, 20, 25, 15, been around that mark forever. The highest is for 750 cows, the lowest per DSE is 1250 cows. That doesn't tell us anything, right? Because that doesn't tell us enough. It's an average and it's just per DSE. We're interested in total farm profit. Next one, so we can go to annual operating profit. We found that the 1,000 cow one had the greatest profit. And the way we ran this farm, in theory, was when we had a feed shortage, we bought in the feed to keep the cow numbers up. Now, you wouldn't actually do that, but that's a good proxy for the costs of a drought. You might have offloaded stock, you might have done all sorts of things, but as an approximation of a cost of a shortage of feed, that's how we've done it. And we found that you had a shortage of feed a lot more often with 1250 cows. We ran it over the last 60 years of rainfall, so as an approximation of the next 10 years' rainfall. So the 1,000 cow operation on average looked okay, but it's on average. Averages are hopeless because, again, it's average just means some years you're above that, some years you're below that. And you can't live on average, you've got to manage whatever turns up. So we've got to look at more than just average annual profit. And so we go to, there's return on capital, by the way, 3.5%. Add another 3 or 4% from owning the land down there. There's 7.5%, still not flash. It's okay if you love what you're doing, I guess. You probably get 10 or 11 in the share market, but it'll be a rougher ride. So Commonwealth Bank did 17% last year, but that's unusual. So anyway, there's still scope to run this place better, I would have thought. But here's the point I want to make. It's risk and return. And this is really interesting because now we've got, on this axis here, we've got a measure of risk, which is, if you get an average profit of 100,000, risk tells us plus or minus. This is what this 40% here. 40%, so it's average of, in this case, 275,000 for 1,000 cows, plus or minus 40%. And you think about, can I live with that? Now what this tells us, 1,250 cows out here, it actually had less potential profit, because had a lot more dry years, a lot more feed shortages. And it was plus or minus 80%. So it's not only a rougher ride, but a lower profit. Now, economic theory says rational people, for the same risk, they prefer the higher income, or for the same income, they prefer the lower risk. If I give you two options, same income, one's risky and one's less risky, I would assume nearly all of you would say, well, I'll take the least risky one if it's the same profit. Is that a reasonable guess about people's behaviour? Because that's what economic theory is based on. So, in this case, we had 750 cows and 1,000 cows, same 40% volatility, but an extra 70 or 80,000 annual profit on average. So that's amazing. Oh, well, 1,000 cow option is the go. Does everyone see that idea? 1,000 cows better than 750 with the same risk, we've got a higher profit. It's better than the 1,200 because we've got both higher profit and less risk. So it's a no-brainer. Okay, and it's a pretty realistic case study, this one, I reckon. So let's have a closer look at this 1,000 cow operation. And this is how we do it. We look at the range of prices you could expect. I have from $1.30 up to about $3.30 or something. We put all the range of rainfall you could get over the next 10 years based on the last 50 or 60 years. That might change, but that's so we run this little budget, so every possible rainfall you could get, every price you could get, you throw it in and just run the budget, right? So we do it 10,000 times. And that's how you get this whole range of profits. And the point is, your business is sort of always set up to handle a fair bit of these years and prices and combinations, right? And by definition, you've got to be able to handle a fair range. It's these ones out here, these rare events at the ends here, that have big impacts. They're the ones that are really going to test you out. And that's where you're exposed if you don't manage them well. And even though they don't happen very often, but here, in that one, there's 90%. 90% of the years will be between 100,000 profit and 450,000. And 10% of the years you'll be between 0 and 100. Well, that's all right. Well, we're not servicing debt yet, see? We haven't really get into this yet. But the performance is not bad. And in some years, you might fluke a good year out here and make a lot of money. And that's life. That's how farming seems to work. But this is the way to think about it. Instead of just thinking, oh, on average I'll get this, it's really useful to think about what plus or minus what, and what do I do when these extreme situations happen. So once we've done that analysis, when we say, well, that the income varied plus or minus 40%, why? And you do a few more calculations and it tells you that price just dominates, absolutely dominates. The seasonal effect, which is the quantity of feed I had to buy in, it affected the variability, second most important factor probably. Actually, the second one was the live weight you turn off was equally important. So they're sort of yield effects. They're important, but bloody hell, price really dominates. Which tells me, geez, I wish we possibly could get a better way of handling price risk. A really good, really well-functioning market where we can sell price risk to someone who wants it, but we don't want it. And we don't really have that situation yet. But that's the theoretical answer, is you just have a well-functioning futures and options market. And if you don't want the risk, you just handle it to someone else, sell it to someone who does want it. That's the economic answer, but it hasn't sort of worked very well in Australia for a long time. So we say, look, there's your 40% variability with before you serviced your debt. So that's all business risk, right? Now, let's add some financial risk now and go in at 80% equity, yes, and look at cash flow. Because this is the one that matters ultimately. No good saying to the banker, look, I made a good profit, but I haven't got any cash to pay your interest. So ultimately the one that drives it all is cash flow. And as you know, cash is king. And for this farm, where we go there, we hit the wrong button. Right, over 5 minutes we'll get there. Just a bit of revision there for you. So this is net cash. Go back over these PowerPoints, just look at a couple of these pictures and just figure out what they're all about, because you flash them up and I know you can't take it all in. I've been thinking about this for months. There's our net range of net cash flows, and the variability around the average is 107%. Okay, so now we've got debt in there, we've paid our interest. The free cash at the end after paying interest is going to vary by over 100% from one year to the next. So that's the point, is financial risk exacerbates whatever business risk exists. And you don't have much control over price and yield. You do have some control over financial risks, so finance matters is the summary. Here's a good one here, probability of servicing debt. And there's at 80% equity, there's 83% probability you'll be able to service the debt in any year. So 8 years out of 10 you'll be able to service the debt, 2 years out of 10 you've got to go and be nice to the banker. If you went with 80% equity. Could you live with that? If not, we've got to go with 90%. This is a good way to present it. This takes a lot of thinking about this little graph here, but I'll try and explain it.
Can you make that bigger on the screen?
That's why I always give you a handout here. I do, because it really takes a lot of looking at.
Steve, it might be a little sharp one. Can you, is there a control for that?
Aaron's out here.
Let me explain what this little graph shows. It's up here, it's a certainty. Right? This is called less than. So you're certain to get less than an income of 550,000 or 700,000 there. Right? Down here, 0 probability, no chance you'll get less than, in this case, about 50,000. So there's 2 points. There's not much help. If I said, oh, good, you won't get less than 50 and you won't get more than 700. That's not very useful. You probably knew that already. But the interesting thing is, there's 20% chance you'll get less than 200,000. So if you set your business up to have a debt of 200,000, that tells you 20% of the time you won't have the cash to service it. Or if you went 90%, there's 10% chance you'll get less than about 150,000. Tells you over there, it's 10% chance, 145,000. So if your annual debt servicing is 145,000, you say, oh, well, that's fine. 1 year in 10, I'll have to shuffle a bit or do something. You can live with that. You might go from 200,000 and say, yeah, 2 years in 10, that's fine because I've got some reserves or I've got some liquid assets I can sell, or, you know, the banker will give me a break and all that sort of stuff. But it's a good way to think about it. So when, you know, after years people saying, how much debt should I have? I've never got an answer. You think about it. You know, you wouldn't want to be running where here, say 50% probability your cash surplus will be less than 300,000. Only 50% probability it will be more than 300,000. So if you've got a debt servicing requirement of 300,000, at 50% probability means every second year you won't be able to meet it. And the banker wouldn't wear that, nor should you, nor should you. It would be too stressful and you'd want to be trying and hope to be lucky. And if you had to be lucky, you wouldn't have any problems about anything. Righto, I'll wrap it up. So that's a really useful way to think about it. It's just putting some numbers on. Have a debt that I reckon most years I can service. And don't think the no debt option is the way to go, because, as we go back to that principle of increasing risk, you grow your wealth faster if you use other people's money well. But just don't use too much of it, because then you go backwards faster. Okay, so that's so that, again, price, the big factor, yield, second most important factor. In this case now, interest rates is in there. No, interest rates is now the second most important factor. Now we've got financial risk in there. I'm going to wrap up. When we did the sums on this, at 90% equity, there was 97% chance you could service it, so that's very conservative. At 80% equity, there was 80% chance we could service that. But at 70% equity, there was 56% chance you could service that. So I reckon on that basis, I wouldn't be too happy sitting at 70, and the banker, I know, won't be happy. Sitting at 80 would be fine, I would have thought. 90, you're too conservative, and you won't grow, you won't be able to set your kids up. So on this business, you'd be saying to the buyers, well, you want to put in more than 70%, but don't think you've got to have 90, you know, and then you weigh it up. So just to finish, there's a few points there which I won't go through, but managing risk, the first thing to do is just be good at farming. As Pliny the Elder said about 100 BC, the farmer's eyes are the best fertiliser. So, you know, that's what he means. Be good at farming. Respect this principle of increasing risk. If we can manage price risk, we'll be making some headway. The portfolio, Prince, we'll get that working for you. That just means don't have all your eggs in one basket. Bloke got a Nobel Prize for that observation. Except it was a bit more subtle than that. He said, don't have all your assets perfectly correlated. If they're not perfectly correlated, you can combine assets in such a way that you'll increase the return without increasing risk proportionally. Okay, a really profound point when you think about it. And so to get that working for you, I'm going to knock off right now. Steve's going to help me. Act counter-cyclically, easy to say. If I knew how to do it, I wouldn't be standing here talking about it. And just don't have too much land, it'll kill you. Or don't have too much debt, it'll kill you. And that's enough of the bleeding obvious, really. Thank you.